For more, let's get to our own Steve Liesman out in Jackson Hole with a CNBC exclusive interview with Federal Reserve Vice Chair Richard Clarida. I hope that you guys have cell service there so you can monitor the tweets, Steve.
Yeah, Sarah, they have definitely seen the tweets here. We're going to get to those in a second. Thank you very much. We are joined by Federal Reserve Vice Chairman Richard Clarida. Richard, thanks for joining us.
Of course, Steve. Good to see you.
On a great, interesting news day, I guess, for sure. I want to start with the market sell-off. Down 623 points, down 745 at the low. How do you process as a policymaker the impact of something like this on the economy and overall the volatility in the stock market?
Well, you know, Steve, we're really looking into the economic outlook because that's what's going to drive our decisions. The economy's in a good place right now. You know, markets go up and down, so we try to filter through the day-to-day. But obviously, the global outlook has worsened since our July meeting. The global economy is slowing, and there are disinflationary pressures. And so we're not looking at any one day, but we're looking at the trend in the data to make our decisions.
What about, though, something I've heard from several Fed officials, which is financial conditions overall, and the way a lower stock market suggests tighter financial conditions, something that all else being equal, the Fed has to offset?
You know, we do look at financial conditions. We want to try to understand why they're changing. And obviously, they can go up and down for a variety of reasons. But trends in financial conditions are a factor into the way that we do monetary policy. Absolutely.
I mean, you're just not sort of dismissing a 600-point decline in the Dow, are you?
Well, I'm not dismissing a 600-point decline in the Dow, obviously. But again, we're looking at the longer-run trends in the economy and in the financial markets to get a sense of where the economy is going and the appropriate monetary policy.
Let's come back to that in a second. Give me your summary of what the general message was today of Fed Chairman Jay Powell's speech.
You know, the economic outlook is favorable. The economy's in a good place, but there are some significant risks. The global economy is slowing. There are powerful disinflationary pressures. There are uncertainties about trade policy, and those are factoring in. You know, we run monetary policy for the U.S., but we have to take into account global developments. They impact exports, they impact inflation, and we're going to factor that in as we need to.
Let's talk about your outlook and how the U.S. economy is performing right now relative to your outlook.
It's in a good place. The consumer is very strong. Labor income is strong. The unemployment rate's at a 50-year low. Top-line GDP has been coming in at a solid rate. I think if you look at the other parts of the economy, exports are down. Capital spending is soft. Manufacturing is soft. And so we need to look at the entire picture. But the top-line numbers look good.
Is it an economy that needs further accommodation, further easing, further help from the Federal Reserve?
Well, you know, we adjusted policy at our July meeting. Right. We take our policy decisions, you know, one meeting at a time. But as we've indicated, we will do what we need to put in place the appropriate policies, and we'll act as appropriate to keep the economy in a good place.
I guess that begs the question of if it needs it. Are we at that point yet, or you haven't decided yet if we're at that point?
Well, again, we have a meeting in September, and we will certainly go into that meeting. I will, for one, be going into that meeting, look at what's happened since our July meeting. And again, you know, Steve, monetary policy operates with a lag, and so we need to take into account where we think the economy is going into 2020, and that's why monetary policy really does need to look at the outlook more broadly and not just the contemporaneous data.
When you say more broadly, you pointed out some sectors that have been affected by global economic weakness. Yeah. Has it dragged down overall GDP already, do you think?
Well, you know, top-line GDP this year has been coming in about as we expected. The first quarter was a bit stronger. The second quarter came in a little bit below the first quarter. But the underlying momentum in the economy is north of 2%. Which is close to many estimates of trend growth in the economy. And if anything, the data on the economy since our July meeting, the U.S. economy has been coming in pretty well. So again, it's a complicated picture, and I think Chair Powell indicated that in his remarks today. It's a complex picture that we're trying to understand right now. But the important points: the economy's in a good place, low unemployment, stable inflation, and we'll put in place policies to keep it there.
Do you gauge the probability of a recession being higher than normal right now?
I myself do not. I know there are different models of recession out there, and we look at a lot of them. I think you have to look at a broad range of indicators, but the ones that I focus on are not signaling an elevated risk of recession. You know, financial market indicators are to some extent moving in that direction, but if you look at a lot of other indicators, I just don't see it. But we need to be vigilant and alert to the data flow for sure.
the New York Fed as a model, and that's sort of been approaching sort of 30-ish, 40%, which is a place it's been before prior recessions. A lot of that, though, is the yield curve.
I think a lot of that is the yield curve.
What kind of message do you get from a flat yield curve? In fact, today, the 210 was briefly inverted. The 3-month to 10-year, which is apparently the one you guys look at, has been inverted for quite a while. What's the message?
So, Steve, the way I look at the yield curve is that it's certainly a signal that I look at. I think it has a complicated set of constellation of inputs, and you can't take a clear read, but certainly a flat or inverted yield curve is something that I pay attention to. We have to understand, though, that the big flattening of the curve and the inversion of the 10-year 3-month point has really not been so much of what's been going on in the U.S., but it's been the real marking down of the global outlook. We have $16 trillion of debt that's in negative yields right now, a lot of capital flowing into the U.S., and that's been driving down our yields sort of over and above what else is going on in the U.S. So we need to try to understand why the yield curve is flattening or inverting, but it's certainly a signal that I look at.
Is it possible that a yield curve inversion or a flat yield curve this time means something different than from what it did previous times?
Of course, it could mean something different, and a lot of experts, many of whom have been on your show, said you need to adjust for term premium and all that, and I understand that, which is why I'm not handcuffed to the yield curve, but I wouldn't ignore it either.
Robert Kaplan, the Dallas Fed president, pointed out that the Fed funds rate is above all other points on the yield curve, which is astonishing to think about that. And for people at home that don't understand that, it means the price for overnight money is higher than the price for 10-year money.
Yeah, well,
is that right?
Well, not only that, Steve, but it's currently U.S. federal funds rate is above rates in other advanced industrialized countries of the world. So, you know, we are in a global economy, we have a global capital market, we have a global trading system, and those global forces are powerful, and we need to respect them, and I do.
Respect, I understand, but more pointedly, I guess the question is the differential with global yields a reason to bring down interest rates?
I think you need to look at a potential implication of that for exports, for manufacturing, for the U.S. economy. So again, you can't mechanically look at any one linkage, but you need to respect that we're part of a global economy. If the global economy is slowing, other central banks are easing, and they're responding to a common global slowdown.
Let me change gears, but speaking of respect, President Trump today asked the question, is Jerome Powell a bigger enemy than Chairman Xi? How do you react to that?
Well, let me talk about the Federal Reserve. This is an institution created by Congress more than 100 years ago. We have an obligation from the Congress to try to put in place policies to achieve maximum employment and price stability. That's what we're doing. We have low unemployment, we have stable inflation, and we're going to continue to focus on that mission and deliver the best economic outcomes for the country that we can.
I mean, I get that, Richard, but you're personally, when you hear the President of the United States call the chairman of the Fed an enemy, how do you react to that?
Well, I wasn't looking at tweets this morning. I was in there listening to the conference.
I promise you that was the tweet.
Okay, well, anyway, I'll just talk about what it is that we're doing right now.
So no personal reaction to that? Your jaw didn't drop? You didn't have any?
Anyway.
You don't think that's inappropriate?
Well, what I'm saying is that I didn't see the tweet, and I'm here focusing on the conference and your interview. So.
Let's talk about generally the effect, if at all, that the president's continued tweets have on the Federal Reserve. As of yesterday, I guess today would be 20 days out of 23 days or 22 days in the month of August that the president has tweeted about the Federal Reserve. Does this have an effect?
Well, again, we have a very clear assignment from the Congress. We have a committee, 17 strong. We have a set of tools and staff that help us think about the economy. A lot of folks have opinions on monetary policy, including some others. And so we're just focusing on doing our job. And it's certainly not having an impact, as I see, on the committee and the way that we discuss appropriate policy.
Let's pivot a little bit more to the trade issue, which is out there. A couple times now, the Fed has acted, and the next day, a major trade announcement from the president. How does that work in your mind now? Are you now factoring in worse or at least unresolved outcomes from trade in your forecast for the future? Or do you have built into your forecast an idea that these trade problems go away?
Well, what I would say, Steve, is that, as you know, your viewers should know, we don't do trade policy. We don't opine on trade policy. We just really focus on the outlook for the economy. Obviously, to the extent that trade policy impacts that outlook, we have to factor it in, and we do factor that in. In some important respects, we're just going along meeting by meeting, looking at the impacts that we see in the data. We have contacts in business in our beige book, and folks who come into the building who we see, and we're just trying to draw on a broad pool of information to get a sense about how trade's impacting the outlook.
Tell us about some of those contacts and what they've told you.
Well, we are hearing from those contacts that uncertainty about trade policy is having a dampening effect on investment and on economic activity in certain sectors, and that's certainly something that we have to take into account. There are different indexes of trade policy uncertainty, and they are elevated.
What people may not know is the extent to which you are a recognized global monetary policy expert, somebody who I've known for many years in the field. Is your estimation that monetary policy can offset trade policy? The chairman seemed to suggest not today. Was that his basic message?
Well, what monetary policy can do is to use its tools to do the best it can to keep the economy close to full employment and stable inflation. Depending upon the shock hitting the economy and depending upon the response to that shock, the insulation may not be perfect. I wouldn't single out trade policy per se. I think what the chair indicated today is we in the U.S. don't have a lot of experience with how the economy will respond to this, because the last 50 years really has been a period of trade liberalization, and we're into a different period now. We just don't have a lot of experience with this. But again, we don't do trade policy. We're just focusing on the impact for the outlook.
I get that. And more specifically, the question becomes, can a lowering in the price of capital or the price of debt be something that offsets a rise in tariffs or a decline in global trade?
Oh, sure. Oh, yeah, absolutely. Because in the end, a trade shock is going to impact exports and potentially investment, and monetary policy makers have the tools to deal with those shocks. But different shocks require different remedies, and so we'll just have to assess this as it proceeds.
Let's talk a little bit about a tale of two economies here, right? Yeah. We have a situation, let me even talk about one specific area, business.
Yeah.
CapEx has been declining and somewhat weak, certainly weaker than expected. But hiring remains relatively strong.
Yeah.
Do you think it's a weird sort of set of data points that you have? Businesses are cutting back on the CapEx side, not on the hiring side. Does that raise questions to you about really how the confidence level of CEOs?
I think there's an element of that, Steve, but what I think it would say is that the U.S. economy is really one of the, really the bright spot in the global economy right now in terms of growth, productivity, employment, and it's a very robust and resilient economy as we're seeing. Again, we had strong capital spending numbers last year, so it's hard to know how much of this is transitory and how much is sustained. But that's obviously something we need to consider.
And real quickly, the issue of the consumer versus the manufacturer. The consumer seems to be strong, manufacturing weak. Manufacturing clearly global. Is the consumer able to sustain him and or herself in the face of what's going on in the manufacturing sector?
Well, I think so far, manufacturing is tied into the global economy. It's a relatively small part of economic activity, but it does tend to be correlated with other things that we look at. Again, the U.S. economy is resilient. It's in a good place, and that's a good position for us to be in here today in the beautiful Grand Teton Mountains.
Yeah, that's one more thing. So that's where I want to end up here.
Okay.
If we should both be so lucky to be back here in this incredible spot next year, would you say it's more than likely not the U.S. economy is growing a trend, or are we fighting a recession at that time? What's your best bet for this time next year?
My guess next year is that the economy will be at or above trend growth under appropriate policy.
And you won't tell me what that policy is. Is
that meeting by meeting?
Higher or lower?
A meeting by meeting.
I had to try.
I know you did.
Vice Chairman, thank you very much for your time. Vice Chairman Rich Clarida, live from Jackson Hole.